let's go back to our profit and loss chart. And Guillermo had said, I was looking at the repairs. There were zero net stock repair options available August. But I'm looking at buying the 113 August. Let's take a look at what we've got. Now, I'm assuming you meant standard expiration. You didn't say, but I'm going to go, Guillermo, with standard expiration. So we're going to buy the 113 call. Okay, you must have been doing weeklies because there is no 113. So I'm sorry, folks. I apologize for that. Let's go to the August 1st weekly. There it is. The 113 call. I'll explain why. And 123s. So I'm going to buy 113 at 613. Oh, okay. And it's a debit repair and sell 2 123s. So Guillermo is saying, okay, I see what the repairs offer. There were some repairs that were there, but I'm going to do this here. We're going to buy 113 and sell 2 123s. Didn't realize it had to be the weeklies. My apologies. And let's just drop this down to true midpoint, 612 versus 233. Okay. So we buy a 113 call at 612. We're going to sell 2 123 strikes at 466. So we've got a debit, an additional debit into this position, a debit repair. Looks like about $1.50, roughly. Now, I'm still seeing a negative return, Guillermo. I don't know what time you looked at it earlier today, but I'm still seeing a negative return. This does not get you back to break even. I'd be more tempted to go with that October credit one, which does get me back to break even. There is the September debit one in this case that we saw that would also get you back to break even, but at 122.61. Okay. You're not at a positive repair here. You're doing it at a debit. Why don't I like to use it as debit? Let me reflect back on that, ladies and gentlemen. In the credit repair, I know we only got 20 cents on that credit repair that we saw, but that lowered the cost basis slightly, just like selling a call against the position. I don't want to add the debit in this position because what I said before, let me go ahead and minimize this window. I'm just seeing a negative MACD crossover here and the stock's been pulling down. I add a debit repair to this position, I'm adding to the cost, and if the stock continues to fall, I'm losing more money in the trade than I am right now, obviously. But I'm also losing more because I paid that extra debit to get into the repair. That's why I don't like to use the debit repairs if I have the option not to. Now, let's go back to that other window I was just in. Sorry, I got a couple windows up here. And Guillermo said, I can always close the stock repair position sooner if I don't necessarily want to wait until break even. At this moment, I'm happy if I can get out at a 5% loss. That's true. But this doesn't enter break even. Let's say the stock only moves up to 118. I'm going to say 120. Let's keep the math simple, Guillermo. Let's say the stock moves up to 120 in the next, what's a good day? Well, I'm not going to go 21 days, but okay, let's go July 4th. Market will be closed anyway. Let's go 4th of July. In 21 days, with your repair, the stock moves up to 120. Let's go ahead and calculate that. Now, you have a loss on the stock of $13.41. We know that. You've got a profit on your 113 call of $3.10. And a loss on your calls at 222. The calls, they're still going to have time value. That's why it's a loss there. Your sold calls at the 123 strike. So you'd be at a loss of 1253. Now, a little better than where you are right now. Perfect. That's fine. But not the 5% you want, right? This is going to be closer to, 1253 cost basis here. Yeah, you're going to be closer to about a 8 or 9% loss. Why am I using those numbers? I'm just using them arbitrarily. I mean, he might be right. Guillermo might be right. I don't mind eating my words. 120 on July 4th, 21 days from now, because he said you could always close it early if the stock moves up as you expected. Let's go to the October credit. Break even of 121.61 again. And of course, that's at October expiration 126 days away, not 49 days away that you were looking for with the August weekly series, your 113 and 123 calls. Stock price is at 120. And on July 4th, 4th of July, 21 days away, 3 weeks away. Yeah, okay. So you did beat me in this case, and that's fine. My long call would be worth 381. The losses on my calls would be 462. So I'm still at a total loss of 1422 compared to your loss of 1253. Let's hit your break even. Your break even was at 122.60, I think it was, on August expiration. But let's do that on July 4th early. Our loss would be at 1237, equal to what you're showing. Your position would be a little bit less, okay? So based on expectations and when you expect the stock to move back up, and you know Baba's going to swing left and right based on those things, Guillermo, what I can tell you is obviously what you know, the benefits of this. Now let's pause for a moment and take a look at the benefits of this. Give ourselves some breathing room. Stock needs to move up 10 points. Yeah, we're 126 days out in time. We're still at a loss if the stock moves up 10 points with this repair in the next 126 days. How would I manage this at that point if I'm still at a loss? Why would I take a loss? You don't have to. Remember what I said. I'm going to take a step back here, Guillermo, and then we're going to go back to your discussion there. But for the stock repair itself, we had a stock position. We entered a ratio call spread, which would have infinite risk to the upside with a credit or a debit, because one of those sold calls is naked. But in the context of both, we have a bull call debit spread, 125, 110, and we have a covered call with, yes, our stock at 133.41 purchase price, but a 20-cent net credit and getting close to the 15 points back gets us to the break even. The maximum return would actually be that 5 or 6% profit that we saw. So in 126 days, we're talking, of course, let's just call it 4 months out in time. We can get back to break even with the stock trading at 125. If it goes up to 130, 135, suddenly breaks above us, what would we do? How would we control this? What do you have? You have a covered call and a bull call debit spread. You leave this alone and let it get closer to that maximum profit. As the stock goes higher and higher in price, these options are getting closer and closer to intrinsic value. But when the stock goes above 125, maybe to 126, 127, in your case, Guillermo, by August, 123, I would treat this part just as a covered call. I would use the PowerOptions tools to evaluate rollouts just to roll this 125 call up maybe to the 130, out to, from your August weekly, maybe out to September. Just continue that as a covered call that's moving up in price and getting closer and closer to the full 15. Separate the two positions out because that's what you have. A bull call debit spread combined with a covered call. You treat this one contract against this 100 shares of stock exactly how you'd manage a standard covered call position that's moving against you or going with you. Now, if the stock continues to fall, you want to consider something else. What is the one thing that the stock repair doesn't do? Just like selling a call against a position month by month, 4 months to make back $2,054 loss in this case, right? Well, you've got to figure a way to address the downside or just exit the position. As Guillermo mentioned, I'd be happy with a 5% loss instead of taking the loss we're seeing right now. This is about 15.5, 15.4%. Pros and cons. This doesn't address the downside minus the net credit that you receive. You can see that here. We expand the stock chart out further. You can see it. Do I have a capped gain to the upside here? Yeah, because I have a covered call and a bull call debit spread. So I've capped gains in those situations. All right. Now, I kept writing this 4 months down. We have stock at 133.41. Currently at 112.87. We're down that $2,054 or whatever that we saw. And at the same time, it's 15.4%. Why not just sell a call week by week? Let's go month by month to keep the math simple. Let's go to July 11th, 28 days out in time, close to 30 days. Yeah, I could use 35 days. We're going to use the 28 day out in time. Now, I don't necessarily want to sell the 113 because Baba could suddenly gap above that. Maybe not the 114, maybe not the 115. We'll use the 115. We'll give ourselves 2 points of breath on the stock. And what is my premium? It's going to be about 350. All right. So I'm going to sell the July 28 days out in time for 350. All right. Locked into it. If it moves up above 115, I've got to scramble because if I let it be assigned, I'm locked into a loss at 11.5%. Better than the 15.5 I have right now, but again, not there. That October stock repair that we did got us to break even at 121.60. Guillermo, yours was at 122.60, I believe, but ours, with the credit that was shown for October, 126 days out in time, was 121.60. That was the break even, and a 5% profit if the stock was above 125, 5.6, 5.7. If I'm selling 2 to 3 strikes out of the money, volatility is relatively the same, and I'm getting 350 28 days out in time by selling this call, and I sell it 4 times, I'm going to make a premium back of $1,400. I'm still at a loss of $600. Now you can say, okay, well, I'm going to roll it. I'm not going to allow myself to be assigned. I get 350 at the 115. Baba moves up as I expect. It goes up to 114. Now I'm selling the 117 and I get 350. And then it moves up to 118. Okay, so I buy it back for 150 and then sell the 121 for $3. You're only making $1,400 back. In 4 months, just with a movement up 6 points, 126 days, you'd be at a profit of 5%. If it moved up to 125, if it just moves up to 121, 6 points and 60 cents, 6 points and 60 cents, you're at break even. Here you'd still be behind. You've only would have sold 4 right cycles to get back $1,400. Even if the stock stayed the same, you're only getting $1,400 back. In that case, that's the comparison. What is your expectation for the stock? If I have a repair that's out, the only repairs I see, debit or credit, are out 180 days, 200 days, 210 days, yeah, I might be tempted at that point to just sell calls on a weekly or monthly basis to try to get back to break even. But what am I risking? The unknown, interest rates drop, tariff talk drops, I should say Powell cuts interest rates, tariff talks drop, the 3 conflicts we have globally right now sort of de-escalate. I don't see how any of those are going to happen with a fresh one that just happened today and beyond. But all that's going to be positive news. These kind of tech stocks, these kind of volatile stocks, they're going to be the first ones to bounce 5, 6, 7, 8 points. And if I'm trying to catch weekly premium here at the 114 strike, and at the beginning, okay, so maybe Monday we sell the 114, but by Wednesday, Baba's up to 118. Well, I only probably got 30 or 40, 50 cents, maybe $1 for that option. Now I'm paying $4 to buy it back. I'm going against myself. Okay. That's the trade-off. That's what you got to look at. The pros and cons of doing just your static. Hey, I'm going to fix my broken stock position by just selling a call week by week or month by month close to the stock price. And if it gaps up, I'm in trouble. Versus tracking the position in the portfolio, going to position actions and position analysis to see the math done for you on some of those rollouts, or going to the signature tools and going into the stock repair, putting in your stock price, your cost per share, the number of shares, and seeing what repairs might get you back to break even faster. Portfolio tools to track and manage your trades, repair strategies, not just for stocks, but for other strategies as well. That's what we've got.